Hi, everyone, and welcome to another session to value and analyze companies. In this session, I'm going to dive into Intel and assess the fair value of equity in the business. There is a great documentary by CNBC, which is about an hour long, that covers the history of semiconductor industry, ASML, Intel, AMD, and dives into the details, what happened to Intel over the past 10 years, how they lost competition to AMD, TSMC, and what's their game plan now to get back into the race and get back market share. The short version of the story is Intel has been designing and manufacturing chips. However, TSMC has been focused on only manufacturing them. The design was outsourced by their own clientele, such as NVIDIA, AMD, etc. The reason Intel has been losing market share is they couldn't manufacture the design that they had, and they were not willing to outsource it to TSMC. So they start losing market share on both sides, and that's how it just turned out. And you can see it throughout the income statement of the company that their moat is deteriorating and their operating margin getting lower and lower and lower. The new CEO, Patrick Gelsner, is hoping to turn the business around. We will see what will happen. They are opening a couple of fabs, one in Ohio, one in Arizona. There was a CHIP Act that was passed a couple of weeks ago, which was about $50 billion, and some portion of it will be allocated to Intel, and they will be a beneficiary in here. So that's really the big picture at what's going on. The documentary summarizes it in a great way. There are other couple of content creators that I found their content about the semiconductor industry and Intel itself pretty educational. No affiliation with them, but I leave their video in the description below. Feel free to go and watch them explore. With that said, let's dive into the valuation of Intel and see what would be the fair value of this business if you were going to invest in there. So before getting to the valuation specifically itself, I need some parameters for the DCF model that I will be conducting. Here is the beta of the business unlevered across the 12 companies that I have: Texas Instrument, NVIDIA, Intel itself, and so on. I unlevered the beta of those companies and take the median as an estimate for the risk in the business. And over time, that number has been around 1.3, 1.4. So that's about the beta that I need unlevered. The next thing that I will be really focused on is the revenue and the margin. Now, why is that? It's because revenue is declining. Intel will be losing market share in the next couple of years, 3 years, until the fabs are built, and the fabs would be the new medium to manufacture chips for other clients, and that's how they will be seeing growth in the future. So the story that I can see to manifest is revenue decline, then we see a recovery, and then Intel would become another mature company we can value as a going concern. So what I would be focused on is revenue growth, and margin. The operating margin and gross margin has been coming under pressure, specifically in the last quarter. If we just look at the past before the last quarter, this number has been around 55, 56 to 50%, but it's been heading down. Same with the operating margin. These operating margins are adjusted for R&D. The reason I adjust for R&D is because I see R&D as being a capex, and accountant doing a horrible job of accounting R&D. So I go back for the past 3 years. I capitalize R&D to come up with the adjusted operating income and operating margin for the business. If I do it for Intel, for the trailing 12 months, this number is about 22%. For the last quarter is about 2%. Prior to the last quarter, this number has been about 27%. But if you would see, before all this trouble to start to manifest, Intel's operating income has been about 34%, and that was the moat perhaps around the business. They have a high operating margin, also relative to the peers back then. If you see in the historically, Intel has been having high operating margin relative to AMD, very close to Texas Instrument in the past, and Qualcomm and so on. But we are seeing that's being eroded and going away. It's because they don't have any moats anymore, because they're falling behind, they're losing competition, and they're being replaced by the competitors. If anything happens, if Intel make a recovery, it would be at a lower operating margin. It would be perhaps around 27%, not at 30, 34. It won't be as good as it used to be. Those good old days are behind Intel. In order for them to get back market share, they need to underprice their product relative to the peers. So the next metrics that I'm really focused on is about reinvestment. So if they're going to grow, the grow is not free gimmick. They have to reinvest back in the business. Well, they're building fabs. That's about $26 billion they're putting there. So looking at the sales to capital ratio, that's relative to the amount of revenue divided by how much the value of operating assets are. That could be property, plants, patents, value of research, etc. The value of research, it's not there on the balance sheet because it's R&D and it's considered a operating expense. So I adjust for that, and the adjusted number would be somewhere between 42 cents to 52 cents, depends how you measure it, based on the most recent number. But again, before just the past 1 year, this number has been around 60 cents, fluctuating between 50 to 60 cents. If you don't adjust for the R&D, then you would get a number about 82 cents, which is, I think, far too optimistic. So with those information that are really critical into my valuation, here's my story. Intel will lose market share and consequently will lose some revenue between the years that the fabs are being built, which is 2020 through 2026. The fabs are the new mediums for Intel recovery from 2025 and 2026 moving forward for the next 4 years. Then from there, growth will slow down, and then Intel will have a decent amount of market share and a decent amount of revenue, but at lower operating margin. So that's the story I'm telling. These are the parameters that goes into the model, the beta, the equity risk premium, the unlevered beta, the terminal beta. I'm reducing the beta to 1.1. The reason I do this is because as chip is more needed, it becomes a less discretionary product, as it's being placed in every pretty much device that we have in our homes, in phones, in lights, in fridge, and TV, and etc. The risk of this business is being reduced. Not just Intel itself, but the industry that they are in. The operating margin, I am picking 12%, increasing that to 27% in the terminal year. That would be about 13 years from today. The sales to capital ratio that I chose about 55 cents, and I'm increasing that to 65 cents over the valuation interval. Doing that, this is the DCF model. I value the operating assets. That comes to be $132 billion. Then I add cash and the long-term investment they have and the short-term investment they have. The long-term investment of Intel is in stocks, it's in holdings in other companies. So that's not a long-term investment. There's plant and equipment, etc. Then they have about 34 billion in debt. So the value to the firm is 164. Subtract debt, you get to 130 billion. The equity is about 130. Stock is fairly priced. Not a bargain. It's not a trap, in my opinion, at this point. It's fairly priced based on this I just said. I think that's what market is really pricing. Doing some sanity check on the DCF, the revenue currently is at 70 billion. It's going to decline all the way to 60 billion. So going from 70 to 60, they're going to lose 10 billion. And then from there, they start doing the recovery. And the terminal year, it's going to be about 135 billion. That's a pretty optimistic story. It's pretty optimistic. The sales to capital ratio starting from 55 going to 65. These are the reinvestment, and this is the present value to the firm, and this is the terminal value. 100 billion of that 130 billion is coming from the terminal year. That's nirvana, and that's where we are hoping to get to. Here is the Monte Carlo valuation, because the story I said on the top was my base case. However, I am uncertain about a lot of these parameters. I'm uncertain about risk-free rate. As you just see, the T-bond rate, the 10-year treasury bond, it's been volatile the past couple of weeks in the market. The equity risk premium, oh my God, the market has been so volatile this year. Who knows what the real equity risk premium would be? So I built some flexibility in the model. I use a normal distribution for a risk-free rate with 1 basis point standard deviation. For the equity risk premium, I use a 5.5%, very similar to the base case, but with a 2 basis point as a standard deviation. Then I build a range around my beta, my terminal beta, my sales to capital ratio, which I'm uncertain about some degree. But the one that I'm really most concerned about is the current operating margin, where it could be, and the terminal operating margin where it could be. For the current operating margin, I'm assuming somewhere between 7% to 17% going forward. And the terminal operating margin going to be somewhere between 21 and 33. And I'm, having my base case around 27. These are the distribution for the revenue growth. I'm using a skewed norm, slightly skewed to the left, because if there's any surprise, it would be in the negative side as opposed to in the positive side during the decline. Also, same with the, in the growth phase, because they would be facing headwinds in recovery. So with that, I run the model. I run 10,000 DCFs and compute the equity value of the business for 10,000 times, and then I draw this distribution. This tells me what's the reasonable range that I should consider about the assessing equity value of this business. Cutting through the chase, 108 is my 15th percentile, and 148 is my 85 percentile. The stock, again, is about 130 billion. I like to think about in terms of business, not just the stock. So the business is being sold for about $130 billion these days. And that's not a bargain. It's fairly priced. And no surprise, this number that I get is very close to where I got on the DCF point estimate on the top. It's because I built the DCF around the base case. I extended the range of the possibilities for these parameters. I see there's a skew numbers here in the distribution. So what it means if this is like a lottery ticket. The probability is low, but it's there. It is possible that Intel recovery could be much better than I'm thinking, and I could be rewarded for that. The probability is low, but if you hit it, it's like a jackpot. That's what I'm saying in my Monte Carlo valuation. So with that, I hope you found the session useful, and thank you very much for listening, and I see you in the next video.